In recent years, one class of investing has picked up a lot of importance, and that is passive investing. An index that tracks the prices of a group, or you can say a basket of stocks, like the Nifty 50 index or the Sensex or the Nifty 500 and so on. An index provider uses a very specific methodology to create these different indices. Now, we all know what an index is. It is used to track the prices of an underlying set of securities. So passive investing, in simple terms, seeks to track the returns of an index for an investor. So let's understand how you can use passive investing in your portfolio. Hi, I am Sumaira Abidi on another episode of Mind Over Money, where you begin your journey towards financial awareness. The funds which track these indices are called passive funds. So it could be products like index funds, ETFs, fund of funds. And the reason it's called passive is because the product aims to replicate the performance of the index which it tracks, and therefore replicates their returns subject to tracking error. Now, unlike active investing where fund managers go out, they choose what to buy, what to sell as per the objectives and of their scheme and the investment philosophy, passive investing aims to only mimic the returns of the underlying index. So let's talk about the different kinds. Index funds are mutual funds that track a specific market index like the Nifty 500 or S&P BSE Sensex. They're designed and they offer investors broad exposure to a particular segment in the market. Like any other mutual fund, index funds have NAVs that are declared at the end of the trading day. You go and buy and sell them like you would any other scheme. But ETFs, or exchange-traded funds, are a little different. So they are similar to index funds in the way that they replicate the index, but they are different because they can be traded on stock exchanges throughout the trading day. This feature allows investors to buy or sell ETF units at prevailing market prices on the exchanges, providing liquidity and flexibility, which is similar to individual stocks. And just like stocks, the price of ETFs also fluctuates throughout the day. And then there are the fund of funds, or FOFs. So what happens here is that instead of investing in a pool of securities like stocks and bonds, FOFs invest in units of other mutual fund schemes, which is why the name fund of funds. Now, some FOFs focus on actively managed funds. Newer FOFs may invest in more passive indexes and exchange-traded funds. So compared to an active mutual fund scheme where the fund manager buys and sells stocks as per their strategy, a passive fund has no active decision-making, since the scheme aims to replicate an index, which is why the expenses in passive funds are relatively lower. And what this means for you as an investor is that they have a lower expense ratio than active funds. Not only that, they're also simpler and easier to understand and track. So how do passive investment products work for you? A passive product can deliver three major advantages to your portfolio. The potential to enhance portfolio returns, aims to reduce risk, and align with your long-term investment objectives of delivering returns that match an index subject to tracking error. So now you're probably wondering how to use passives in your portfolio. Well, there are three broad ways to do it, right? So let's start with asset allocation. Passive funds provide a wide access to diversification within each asset class. For example, you have assigned a certain equity debt asset allocation. Now you can choose from within large cap and mid cap indices, and likewise for debt, you can choose different durations and then diversify within each class. Next, they can be added by those who use a core and satellite approach. Here, passive funds can be at the core with an aim to provide stability, and active or even thematic funds can be in the satellite portion. And finally, you can use passive funds to take tactical calls in anticipation of major events like, say, changes in interest rates or changes in the macroeconomic policy, or even if you're looking to move from one sector or theme to another. So to wrap it up, passive funds are a simple and relatively low-cost solution that aims to offer a compelling solution for investors for all their investment objectives. So do give it a try if you haven't already. That's it from me on this episode of Mind Over Money. If you like this podcast and you want to be reminded of our future episodes, then do subscribe on all your favorite audio platforms and also follow the SBI Mutual Fund YouTube handle. I'm Sumaira Abidi and I'll see you again soon.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.